This is the last time you're going to have to hear from me today. Yay! This is a good time when it's not good to hear all the applause going for that.
It's pretty, though. I was going to say, I do like the color.
I like the color. It matches your curtains, I think. Fortunately, this year, for everyone having to listen to this, the 2020 session did not provide much in the way of new legislation that affects counties, so this is probably the shortest presentation I've ever done on new legislation. I can hear the applause now. So I know you are relieved to hear that. And again, there's been enough turmoil this year. We don't really need to add more changes. That would be a bit too much. I've included some slides we're going to go through kind of quickly. The more time I have, the more time that Ricky has, and then we can hope maybe even get us done early. But I wanted you to have the information. If it comes up later, you can go back to it just so that it's in your head, not that you have to memorize this or know all of it. So for on each slide, again, I put the bill number if you want to read the actual bill. I put the code citation that's going to be changed starting July 1st if you want to go straight to that code citation and see what it says. I talked briefly about the DLGF bill. However, they are doing a webinar on that. That's really what you're going to want to watch for that. We did have one question on new legislation. And this has been, I think, across the board from all of the associations, a desire not to have to listen to new legislation anymore. Any explanation on 2020 new legislation would be appreciated. Otherwise, no new legislation, in all caps, unless you are eliminating tax caps and overhauling the deduction exemption benefits to the extent that they no longer exist, or at least on a very limited basis. That is totally beyond my ability to provide for you. And I don't think the General Assembly is going to stop passing bills anytime soon. But we can hope. Fingers crossed. Okay. So this first one is just a change on plan commissions. It really doesn't affect you, but I know the auditors or the commissioners rely on the auditors for a lot of information. So I just wanted to let you know when they're appointing to the plan commission. And this is just a change to make sure that these members are county residents. Again, another FYI, this might affect your development and your commissioners definitely, but it is under Public Works. It is designating what office is going to determine what a shovel-ready project is for economic development purposes. This would not be highway, but for economic development. So that's going to go through Okra now. Under controlled projects, they didn't make any change to the process, yay. However, they did allow a county to exclude your road projects, regardless of the cost. It is not a controlled project when you're doing a road project. The definition I've got up here of what they consider, I think it's pretty broad and includes all of that. It is always up to the unit to determine if a project is controlled or not, but this will streamline the process for counties to do road projects. With not having to go through the petition and remonstrance process to issue the debt for that. Protected person, this is if you're getting public records requests for information. If this is coming from an offender, which is now someone that has been arrested as well as someone that's been convicted, and it expands what records are confidential, and it expands who is covered by this to include probation officers, community corrections officers, family members of probation officer, and community corrections officers. Again, it's just to protect your public safety people. House Bill 1065 addressed several tax matters, and I've kind of got them summarized here. There is a statute 6-1.1-9 for the assessment of omitted or underreported tangible property. As you know, that's the review to find property that has been omitted or undervalued so that the assessment can be corrected and the proper tax collected. Section 10 of that chapter deals with the discovery that the property was overreported and the assessment should be lowered. Evidently, there was a problem with this because this section now requires the assessing individuals to correct that error, provide for a refund or credit for any overpayment. What it does is add to the section that if the assessing official does not make the correction, the property owners now have the right to appeal to PETA BOA for the correction and receive credit for the overpayment paid, or file a claim for the refund. And also, if they do not get satisfaction from PETA-BOA, they can go to the state tax board. There are 6 counties that are affected by the next section, and this is how voting for local income tax. So this affects Allen, Delaware, Fayette, Howard, Monroe, and Vanderburgh. This provision will expire May 31st, 2021. This only affects when those counties are going to increase a local income tax rate. Formerly, each unit voted as a single block. Now, each county, city, or town is still allocated a portion of the 100 votes, but within those units, each person is allocated a vote. So they will not vote as a block, they will be able to vote as an individual.
Okay, wait a minute. We have started on budgets, and our plan commission has asked if she can combine the inspector's department with the plan commission this year. Do they need to be kept separate?
I'm not sure what we're asking. The department, I mean, the plan commission is a board, and the inspection is a department.
Inspector's department.
Who can control the inspection department?
Can you be a little bit more specific? I think from this type probably.
And for the voting on the lit for those 6 counties, it's a roll call vote instead of a block vote. Indiana Code 36714 has changes. Last year, they established the procedures for establishing a residential TIF. They are now limiting how long that TIF can be in existence, and that there is required to be direct consultation with the schools that might be affected by the residential TIF. Again, this doesn't change your duties, but you are the treasurer for the RDC, so you might want to know about this.
Okay, our inspector, oh wait, this is a different person, sorry.
Oh.
Okay, hold on a minute. Our inspector is under the plan commission. Is this not correct?
Your building inspector? I don't know if that's a problem. I have to actually look at the statute. The only change in the law was that all of your plan commission have to be county residents.
All right, the other one that we were talking about earlier says just for budget and annual reporting. They are different departments on the budget and annual report and would like to just do one budget for them both. Both departments are ran by the same person.
Budget questions we can't answer, that would be DLGF. I don't think there's a problem reporting them. How you keep the funds, I mean, you're going to report them by fund, not necessarily by department.
Right.
And that would also be driven by what the budget decision is. If they're separate
Sure.
budgets, they're going to be separate departments within there. If they're combined, then there's going to be one. We're not going to take audit exception.
They're in the general fund, just different departments.
Yeah.
So we can send it to DLGF for the budget question.
But if they're allowed to be budgeted correctly, they could be one. There'll be one department in the general fund. Okay, and this is just an FYI as well. This just allows for cemeteries owned privately, for the owners of those cemeteries to turn those over to voluntarily to a township or county for maintenance, but they would have to pay for that maintenance. The county would actually do it, but the landowner would still pay for that. And this affects both township and counties on this. And maintenance means resettling and straightening all monuments, leveling and seeding of the cemetery grounds, maintaining any fences around the cemetery, removing all weeds and noxious plants, and mowing the grass. So that's what would be expected for you to take over if you agreed to do that. House Bill 1108, called the State Board of Accounts Bill. I wanted to especially point this out because we had some calls on this already that said, I think you got a whole bunch more powers. We did not. We did not. We are the audit agency. We are still your audit agency. We have always had the authority to ask for your records and to require the state examiner the authority to require you to file these annual financial reports. That has not changed. There is no new authority that we have over you in this bill. What it does allow is prior to this bill, if you fail to to give us the reports, refuse to allow us to audit, refuse to allow us access to your records, we could go to court, and the court could forfeit your office. Under this new bill, that still exists. However, they have an additional option. Instead of asking you to forfeit office, they can fine you. That's the court, not us, but the court could levy a fine if you fail to file the reports that are required, follow our directions, refuse access, hinder our FEs from actually doing the audit. Okay. There is a section that defines who a responsible officer is. So normally we think of the elected officer, but if there is another, a chief executive officer or other individual who has executive decision-making authority for the audited entity with respect to a compliance obligation, they can be responsible under this law as well to get us that information and face the consequences. It does talk about management letters in there. It adds that to the statute, but they continue to be used as they have been, and Ricky talked about that this morning. If you have a finding that is not significant enough to be included in a report but does need to go to your governing board, that is done in a management letter. What is added to the statute is that if it does not get corrected or increases in magnitude and it becomes a reportable condition, we will include in the report that it was you were notified of this problem in a prior management letter. This is the LGF's bill, and again, they have, write this down on your calendar, they're providing training on June 17th. They're doing a webinar called Legislation Overview, so you'll want to check their website for any additional information and watch that, because they will give you a lot more information than what I'm going to do. I just wanted to point out some of the things in the bill so that you're aware of some of the changes. Under deductions, it did clarify that for homeowners over 65 and for veterans, an increased assessed value of their home that is not directly due to improvements on the property will not force them to lose their deduction. Okay, there was it was not clear in last year's, and so they've clarified that. It does allow the PETA-BOA to change an assessment. It gives a deadline in there of October 30th or 5 months after a personal property tax return is filed. It does add language so the taxpayer can appeal a change of assessment by the assessor to the PETA-BOA and change of assessment by the PETA-BOA to the Indiana board. Additional appropriations, if you do adopt additional appropriations, you must file that request within 15 days. And if you don't, then you may have to readopt. So keep that deadline in mind. And again, they'll be going over a lot more detail on that. For tax sale, it adds that a purchaser at a tax sale must also certify that they are not purchasing tracts or items of real property on behalf or as an agent for a person who is prohibited from purchasing. So they can't get around the law by sending an agent in. So it updated this on refunds that used to be over 100,000. So now refunds over 500,000 or more as a result of an appeal of assessed value, the auditor may choose to, instead of a refund, elect to apply credits in equal installments to future property tax installments over a period, and there is a schedule. So if the refund falls between 500,000 and 5 million, you have 5 years. If it's between 5 million to 10 million, you have 7 years. And if it's over 10 million, you have 10 years. The auditor may also elect to accelerate credits or provide a full or partial refund if the taxpayer is no longer the taxpayer for that property. I expect a cheer, although I know I won't hear it. You are no longer required to provide OPEB information to DLGF. What you report on the AFR is sufficient. So there's only one reporting on OPEB now. It does further clarify the definition of an ineligible purchaser of county property. A person may not bid, purchase, receive, or lease a tract offered for sale, exchange, or lease by the county. Under 36-111, it adds a list of ineligible persons who have the following relationships to those. So you've got persons, partnerships, corporation, or legal entity, or persons with delinquencies in taxes, special assessments, penalties, interest, or cost directly attributable to a prior tax sale. They cannot purchase county property. Or a partner or partnership member of an LLC, officer or director or majority stockholder of a person who controls or directs those activities. Okay, the last one I have, I told you it was quick, is on land banks. It's allowing authority for 2 or more eligible units within a single county or within one county or between 2 contiguous counties to enter into a local interlocal agreement to form a land bank. Too many L's in that, okay? The interlocal agreement should establish the name of the land bank, the number of board members, and the territory. Those land banks are subject to audit. I think we asked you a couple years about, though, if your counties had established those. Please remember that if you do establish one, let us know. We don't know to audit it if we don't know it exists. So just kind of a back of your mind kind of thing, a quick email just to let us know that those are being established. Okay. We had a second question. Can we pursue legislation if that is the appropriate body to require the Sheriff's Department, if there is no one in central dispatch that can complete the PSAP report each year? The auditor may be the keeper of the records for claims paid, but it has become increasingly frustrating to complete the report, and many of the items purchased are foreign to us, and many times difficult to decide what category or section to put the expense. The auditor's office can supply the sheriff or the PSAP coordinator with the reports that they can reconcile to their records, but it still be their responsibility. I guess you can pursue legislation on anything. I don't think there's an issue. I mean, if you can get the director for your PSAP to complete this report, I think that would be fine. But requiring it, that's going to be, until there is legislation, that's going to be a county decision.
I got a question.
Yes.
It says after June 30th, 2020, we will know which of these are in effect, correct?
All of these will be in effect July 1st. Right? I don't remember any that had, of what I went over, that had differing dates. These are all ones that have actually passed. Okay.
Thank you.